Whenever we hear about insurance, we often get defensive. I really get it. Many insurance agencies can make us feel tricked into buying policies that seem useless after a while. But today, I really want to clear things up. I will explain what whole life insurance is and share strategies that millionaires use to build wealth with it. We'll also learn how regular people like us can use it to get rich, avoid pitfalls, and understand the risks involved. First things first, what exactly is whole life insurance? Unlike term life insurance, which only covers you for a set period, whole life insurance covers you for the entire life. Plus, it has a savings component called the cash value, which grows over time. So, one, protection. It protects you and your loved ones by giving them a huge amount of money when you die. And secondly, it also helps you save money. The money you put in remains yours and it grows with interest as well. Rich people use whole life insurance as a smart financial tool because it offers both protection and a way to grow their money. Those people pay higher monthly payments called premiums, which build up savings. And this savings grows without being taxed each year. Paying less tax is a hot topic among the wealthy people, you may know. And they can also borrow money from these savings at a low interest rate. What does it mean? They can go to a bank and say, here's my whole life insurance, and there is 5 million in it. I'll put it with your bank and you can lend me money. And then they use the borrowed money to invest in things like big purchases, stocks, or a yacht without paying taxes right away. Whole life insurance also guaranteed you a payout when you die, giving their family a large sum of money to cover things like taxes or debts or providing financial security. So, as I mentioned, this offered them both protection and money growth. And then you may ask me, for us everyday people, how can we get rich with whole life insurance? And there are basically three ways. The first thing is about building savings over time. The whole life insurance policies let you build up savings account over time called cash value. This money grows without you having to pay taxes on it each year, as long as you don't take the money out. So, for example, if you start a whole life insurance policy at a young age and continue to pay premiums throughout your life, the cash value of the policy will gradually increase. By the time you reach retirement, you could have a substantial amount of money saved up. It's not only about saving, depending on the company, the insurance company will also pay you interest. With compound interest, the money you put in not only accumulates, but also grows at an accelerating rate. And the second thing is about earning extra money through dividends. Some whole life insurance policies give you extra money each year called dividends. You can actually use these dividends to buy more insurance, get cash, or even pay for your policy. You can think of it like owning a tree that grows leaves. In this case, it grows money. Every year, the tree gives you some money. You can use this money to buy more trees, which will give you more money in the future. Or you can just put it in your pocket. And the third way is to pass wealth to your family. Whole life insurance that guarantees a money payout when you die, usually a huge amount of money, knock on wood, which can help your family pay for things like taxes or debts or just leave them as a financial gift. You can actually consider it as having a golden ticket that gives your family a big chunk of money when you pass away. This money can help them cover any big bills or just provide them with extra financial security, ensuring they are well taken care of after you are gone. And now you may think, oh, let me buy whole life insurance. Wait, I haven't finished yet. Before you do, you should also know the cons of the whole life insurance. There are three major risks that you cannot ignore about the whole life insurance. The first one is about high premium costs. Basically, it's expensive. Whole life insurance policies are significantly more expensive than term life insurance. As I mentioned, the whole life covers you the entire life. However, the term life only covers you for only a certain period. So, as you can imagine, whole life insurance is more expensive. The higher premiums means the money that you need to pay in. It can be a financial burden for a lot of people, especially if your income is unstable or if you have other financial commitments, for example, like a mortgage. You buy a whole life insurance policy, but the monthly premiums are so high that you struggle to pay for other essential expenses like your mortgage or kids' education. And this financial pressure can make it hard for you to keep up with the policy payments and may force you to reconsider if the investment is worth it. Consider an example with term life insurance. Imagine you are currently 35 years old and you decide to purchase a 30-year term life insurance policy. And this policy covers you until you are how old? 65 years old, right? Providing your family with financial security, protection during your most critical earning years. And the premiums for this term life policy are significantly lower than those for a whole life policy. And this allows you to comfortably manage your monthly budget, paying for essentials like your mortgage and saving for your children's education without the added financial strain. While the term life insurance will expire when you are 65, it provides a cost-effective way to ensure that your family is protected during the years they are most dependent on your income. So it makes a lot of sense to buy a life insurance for the family's breadwinner. In terms of whole life or term life, then it depends on your budget. And the second risk about whole life insurance is about the complexity and lack of flexibility. Whole life insurance policies can be very complicated with various rules about how and when you can access the cash value. So additionally, they are less flexible compared with other investment options such as mutual funds, ETFs, or stocks. So it can lock you into a very, very long-term commitment. For example, you want to take money out from your policy to invest in a new business opportunity or a new home. However, you'll find the process confusing and time consuming with many restrictions and penalties. And this complexity can make it very difficult for you to use your funds when you need them most. And the third risk is about the potentially lower returns. The returns on the cash value component of the whole life insurance policies are often lower compared to other investment options like stocks or bonds or mutual funds. Over time, this can mean less growth for your money. For example, you compare the growth of your whole life insurance policy's cash value with the returns with a friend's ETF investments, such as an S&P 500 product. You realize that your friend's investments have grown significantly more over the same period, making you question whether your money would have grown more if you had invested elsewhere. So, if you purely want to use whole life insurance to grow wealth, it may not offer you a significantly high return. Why? Because it offers you both wealth growth and protection. Protection here means your family will receive a huge amount of money when you die. So, you have both protection and money growth, but you cannot have the best of both worlds. Life is all about trade-off. If you like this video, you will enjoy my video on how the ultra-rich invest. In that video, I review 3 strategies that wealthy individuals use to manage their money, offering insights that you can apply to your money management as well. Like, subscribe, and click on the screen. I will see you in the next video.